Welcome to Just Think About It with Nadine and Ben. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, YouTube, or your platform of choice. And second, we appreciate any kind notes as we get started and letting your friends know where to find us. Today, we're so excited to chat with one of the best macro experts around, Darius Dale. Darius is the founder of 42 Macro, an investment organization that is heavy on data and process, which is why we're such fans. Prior to 42 Macro, Darius was a managing director and partner at one of Wall Street's leading sell-side research firms, in charge of their macro team and architect of the firm's economic outlook and investment strategy. His award-winning frameworks and processes, well, they're highly sought after within the institutional investment community, and he's a frequent on-air contributor to financial media, including Bloomberg, CNN Money, CNN Biz, Fox News, Real Vision, among other platforms. And he's been published in the Wall Street Journal, Barron's, Yahoo Finance, Fortune, and cited in Jim Rickards' book, The New Great Depression, Winners and Losers in a Post-Pandemic World. He's also someone who gives back, which we really appreciate. He supports local and national organizations for K-12 education, food insecurity, and homelessness. He's the co-chair of Yale Football's 4 for 40 mentorship program, among other organizations. Plus, and most importantly, we're lucky to count him as a friend. Welcome, Darius.
That's a really kind introduction, Nadine. Thank you so much. It's great to be here. Thank you, guys.
And Darius, we've been a big fan for many years and have a solid appreciation for the extensive work that you do day in and day out for clients who look to you for both your processes and also your synthesis of vast amounts of data. And we were listening to Around the Horn, which is one of your call it solutions that you offer clients, from last weekend. And we wanted to kick things off with your current view. We'll come back to process, but which is in our words, first, the Goldilocks versus deflation debate, which you're saying has not been resolved. We don't have to worry about risk assets now because the second quarter GDP revision and July PCE report were supportive of your resilient U.S. economy theme. So those are kind of two bullets. The third bullet being, yes, growth is moderating, but so is deflation until next year. And then fourth bullet meaning, so the Fed was going to be cutting into a late cycle expansion. So, I mean, that's my basic and our basic summary of it. So maybe you can talk a little bit first about that hybrid environment, the Goldilocks and deflation. What is that? Why is that? And how do investors navigate such an environment?
Yeah, excellent question, Eddie, and I appreciate that. So I'll summarize it in layman's terms and then unpack it in the context of our quantitative frameworks. So we're cautiously optimistic on risk. And what we mean by cautiously optimistic, because I do think that is an overused term that doesn't mean a lot when most people say it, no offense. But in the context of our systematic investment process, what it ultimately means is that we expect the general beta of asset classes to remain generally positive over the medium term. However, we do expect the leadership to transition from cyclical leadership to defensive leadership as investors get more skittish around the medium-term growth outlook. We do not believe that the U.S. economy is at or near a recession. However, we do believe growth is likely to slow over the medium term. We expect growth to continue surprising consensus estimates to the upside, which is something we've been calling for 2 years now. And that process is likely to remain ongoing. And ultimately, we're getting close to the bottom of the sine curve in inflation, and that has positive implications for now over the next few months. It could start to have negative implications for asset markets, let's call it 9 to 12 months from now, when it becomes more obvious that inflation is not bottomed and likely, or has started to reaccelerate higher from a cyclical low. And so when you put all those things together, you think about this from a first principle standpoint. What causes trending risk off market regimes, which is what we're all, I think, trying to figure out here in September. What causes trending risk off market regimes are, generally speaking, one of three things, or a combination of these three things. You have a sharp and protracted deceleration in growth, and usually unexpected. You have a sharp, unexpected, and protracted acceleration in inflation, or you have a sharp and unexpected and tightening of monetary and fiscal policy. And with respect to our fundamental outlook, we don't see any of those things as highly probable over the medium term. So in our context, we do believe that the path of least resistance in asset markets is likely to remain higher until we have one of those things or multiple of those things kind of in the near term horizon.
And can I come to you for a second before you go to the data? I mean, another takeaway from your work is that there's a lot of cross currents,
Yeah.
right? So from your global macro risk matrix cycles that lead market cycles, namely policy, corporate profit, liquidity growth, so four within the biz cycle, like you believe we have weeks, even months to support Goldilocks. And when there's so many cross currents in your data, and I know you'll answer this, how do you find conviction in your frameworks, right? So how do you know when things are coming at different angles, like how to play it versus saying, you're just looking for more data to get the conviction to go maybe like more heavily exposed, or how do you process that data when it's not all pointing in the same way?
Ooh, that's a fantastic question. I love that question.
You probably like, I got the charts to show you.
Full disclosure, Nadine has been a client and a friend for a really long time, and she understands how I answer these questions. So you're going to be as good as anybody at picking me apart out here. So I'm looking
Yeah,
forward.
am I like putting the catnip out there? The catnip got thrown out.
Exactly. So let me just take a step back and kind of explain what it is that we do for clients at 42 Macro, because I think that'll help investors understand the answer to the question, which is how do we deal with cross currents. So the number one thing we do for our clients, and that we spend most of our time on, is helping them identify and positioning for the market regime. We use our global macro risk matrix market regime nowcasting process to identify what the market regime is. And what the market regime is, it could be any one of these four outcomes from the perspective of risk on. There's two risk on regimes. One's with a disinflationary bias, the other's with an inflationary bias. The other's the two risk off regimes. One is with an inflationary bias, and the other's with the disinflationary bias. And so it's our job as investors, in my opinion, is to take advantage of the market regime that we're given, not the market regime that we want. And so our job is, we use our systems to identify what the market regime is, and then we use our KISS portfolio construction process and our discretionary risk management overlay to guide retail and institutional investors into the proper factor exposures or the proper asset allocation, depending on the solutions that they're looking for. When it comes to cross currents, getting back to your question, Nadine, to me, I think the cross currents live in these two buckets, which is helping clients prepare for regime change using quantitative signals. And so we have a plethora of models that we use, both econometric and market based, that help us, sort of anticipate, kind of peek around the corner how the market regime is likely to evolve over various time horizons. And then we use our fundamental research, where's growth headed, where's policy headed, where's corporate profits headed, et cetera, inflation, and to help investors kind of peek around the corner as well. And so oftentimes, not oftentimes, but certainly at these sort of, whenever you're at the top of a growth sine curve or at the bottom of an inflation sine curve, or policy starting to change, or there's a lot of uncertainty with policy and surrounding the election, that's when you start to see cross currents develop. The fundamental research may be incongruent with some of the econometric signals that we're generating, or vice versa. And so it's my job as the sort of, chief risk manager here at 42 Macro, is to help clients, appropriately, respond to those cross currents. But at the end of the day, we're only using that kind of information to help clients emotionally prepare for regime change, right? If you're using a trend following process, which this is essentially it is a giant trend following process, what we're trying to do is get clients comfortable when the trend changes. We have sort of backfilling all the research that they need to make the appropriate pivots in their portfolio across factors, across sectors, across asset classes.
Great. And I think, Ben, you want to go a little bit into the retail before we head into more professional? Yeah.
Oh, sorry. I want to ask you about this. So when you think about this system you have, what's the prime mover here? Like, my view of how the economy works is the prime movers are credit and confidence. Yeah. And fiscal and monetary policy are things that prop up confidence and higher stock prices, for that matter. But like, what is it? Like, you're taking the data, but do you ever like say, hey, if then? Or is it just it comes as it is, and you're not trying to anticipate, you're just trying to basically real-time react? Like, maybe explain to that a little bit.
Yeah, that's a phenomenal question. So yeah, we understand what we think we understand based on back testing what the principal, kind of components of markets are. Generally speaking, you're on the real economy side, you have growth, inflation, the labor market, profit cycle, and the fiscal policy. On the financial economy side, you have things like liquidity, credit, monetary policy, and then you have positioning in financial markets. Those are kind of the main factors and cycles that we're tracking, with our fundamental research, and trying to kind of project those things forward vis-a-vis our fundamental research. But, going back to this sort of trend following process that we built, what we're trying to do at all times for investors is respect the trends in financial markets and we help them anticipate the trend so that when the trend changes, they're emotionally ready to make the appropriate changes in their portfolio. The alternative was what I think a lot of other investors are doing, probably most other investors are doing, are trying to constantly anticipate trends, and more importantly, trying to constantly anticipate inflections in trends. And the reality is, just empirically, that's not the right way to do things, in my opinion. The right way to do things is to respect the trend, because the trends are generally persistent over time. Now, they're not always persistent, and there are inflections in the trend, and that's where our market regime nowcasting process kind of comes into play, which is, okay, when is the trend changing? And so we use our global macro risk matrix, which is a dynamic factor model that's based upon our volatility adjusted momentum signal. And what we're trying to do is score each of these 42 markets across stocks, volatility, commodities, currencies, and fixed income. We're scoring all the major markets and exposures in the world through the lens of our volatility adjusted momentum signal. And then we're scoring them relative to how they've traded historically in those four regimes that we identified here on slide 6. And so when we summarize this, we can create time series out of that information in order to anticipate when that market regime is changing. And right now we continue to be kind of mired in this, low conviction Goldilocks versus deflation debate. Currently, 15 of the 42 markets in this model are confirming of Goldilocks, and 18 of those markets in this model are confirming of deflation. But as you can see here, the strength of signal, which is the total amount of signal that the tables generated on any given day, shown on a percentile basis with daily data going back to January of 1998, we're only in the 25th percentile in terms of the strength of signal. So that tells you a couple things. One, the asset markets are incredibly unconvicted as to what is the current trend, what is the current market regime. And number two, that suggests that there's that we're ripe for regime change, because they're so unconvicted. It won't take much in terms of a few signals here or a few signals there in the fixed income, volatility, equity, or credit markets and currency markets to kind of flip the overall signal into a higher conviction regime in support of any one of these regimes. That's what we're waiting for in terms of kind of making a more definitive call on asset markets. But again, I don't think you need to, as an investor, force yourself to make a more definitive call on asset markets. I think one of the things we've proven over the past 3.5 years is that you don't need to be good at predicting to make money and save money in asset markets. You need to be good at observing. And in my opinion, I think that's probably the number one thing we do for our clients is observe and make the appropriate changes when those observations change.
Yeah, and our friend of the show, David Dredge, is a tail fund manager, and he always talks. He doesn't predict, he observes, but he's bond. And this is what a value investor would do too, right? It's like, hey, I want to buy assets that are cheap. I want to buy volatility that's cheap. Let me ask you one more thing on that model. So are those if then? Like, are they just 0-1 signals? And then you're aggregating them, or is there a correlation that can change over time? Do you think about that at all?
Yeah, no, I thought about this all throughout my career, and what I found is that whenever the human being, tries to influence the model by assigning weights to the model eventually breaks down over time. It becomes less resilient to fundamental change, and more. I've never observed that. I don't think any investor really observed that as much as we have in the post-pandemic era, both on the econometric side with respect to forecasting growth and inflation or policy, et cetera, and also on the market side. With any weights you had prior to March of 2020, they're wrong. They've just been wrong, and I think a lot of investors have had at various time intervals to acknowledge that. And I think that's one of the reasons why our resilient U.S. economy theme has been so persistent. Why U.S. growth is continuously surprised to the upside for the better part of 2 years now is because a lot of the models that legacy economists and other investors are using to predict growth and inflation, they're just not calibrated for the new economy that we have. And so what I've learned in this last 4 or 5 years is to let the models determine what the weights should be. Don't use historical correlations or historical weights to determine those things. Just let the model determine that stuff for you. And so we built those kinds of factors and features into our models to account for a more, a more uncertain, a more volatile economic and financial market environment.
Right. And I'm with you. And we talked about it when I was on your show. But the one thing everybody refied their debt at very low rates, and then they've enjoyed the higher cash money market rates, right? And so perversely, net corporate interest expense as a percentage of revenue has gone down.
Yep.
And so the typical things that worked with the Fed raising rates didn't have an impact. And in fact, it helped at the top of the economy, your K economy concept. Do you think that, like, as we approach the refi wall, that maybe some of the more traditional pre-pandemic ways of thinking maybe come back now that we're like 4 years after it and we've kind of cycled through some of it? Do you think about that at all, or are you thinking it's like just a new regime?
Yeah, I thought about this, but probably not in the way that most investors have. So we've done some work on this in the past that shows when historically there have been refinancing walls, they tend to get pushed out over time if asset markets are positive. If you have open capital markets and stock prices are in an uptrend, generally speaking, refinancing walls turn into turnstiles. They're refinancing turnstiles, and so that's generally our take is that if we are in a relatively positive and supportive backdrop from an economic standpoint and policy standpoint for asset markets, then there is no wall. It's really just a kind of mirage, if you will. Now they become a wall. They become walls when there's an issue in the underlying fundamental issue in the economy. Either there's capital misallocation or adverse selection in a way that suggests that okay, there won't be the capital markets won't be as open in these intervals. And so that's in our opinion that's one of the things that we try to do research on is to understand exactly where we are in the broader credit cycle to understand if there's a tremendous amount of capital misallocation or adverse selection out there. And I would argue there really isn't. So if you look at this chart here, so going back to we alluded to earlier our resilient U.S. economy theme. That's something we authored back in this in September of in the summer of 2022 to highlight this to kind of communicate our view that we expect growth to kind of remain resilient and surprise the upside, and that's obviously come to fruition over the past couple of years. There's sort of really four main pillars to that theme. The first pillar is there's a historically strong household sector balance sheet. This is what we call the West Village Montauk effect, which is essentially a large stock of savings on the household balance sheet is contributing to a negative flow of savings, which means we can consume more than we otherwise would, to get the same level of income. So that dynamic continues to persist in the economy. And then there's a historically strong corporate sector balance sheet, Ben, as you alluded to. And then number four, which is kind of landing the plane on this question, is the limited exposure to the policy rate. And so within the context of seeing closed capital markets typically happens when there's a tremendous amount of capital misallocation in the economy. What we mean by capital misallocation is just a lot of money chasing too few good ideas, and ultimately that's not necessarily something we see currently. If you look at the U.S.'s private non-financial sector debt to GDP ratio, it's been declining this entire business cycle, which tells you that GDP growth is growing faster than credit growth, and so that in and of itself is an indication that there's unlikely to be capital misallocation in this particular business cycle. Another way to look at this is show that same information on a 5-year Z-score. Historically speaking, if you go back and you kind of study the business cycle leading into recessions, generally speaking, you're talking about a 5-year Z-score, the private non-financial sector credit to GDP ratio, somewhere between 1.7 and plus 2%. Heading into a recession, which is indicative of capital misallocation and adverse selection, which is obviously, kind of looking for worse and worse, lower and lower credit quality borrowers to extend credit to because you have too much credit to extend. And we just have not seen that dynamic play out here. A couple more things that have been pretty supportive for the economy from a credit cycle perspective. The private non-financial sector debt service ratio has risen a tremendous amount. We have a 1.7 Z-score on a trailing 5-year basis, but it's still structurally low. It's only it's only 15%. You got to get back up there. Not you don't have to, but historically speaking, we've seen kind of levels that are kind of approaching 20% when you heading into a recession in that time series. If you look at the bank share of private non-financial sector debt, it's only at 33%. So that essentially says that the other 70% of the private non-financial sector debt in the economy is coming from the capital markets. And as long as capital markets remain buoyant, we're not going to have a credit cycle, at least a down credit cycle. So we probably suggest that the main leading indicator for this business cycle is probably going to be the S&P 500, which is kind of unusual, but we need to understand that in the context of these dynamics, because I think a lot of economists and investors are out there, looking at things like the labor market, things like the credit to try to, guess where the markets are headed. And the reality is, in this particular business cycle, that's not going to work.
Yeah, and actually, I love that you ended it like that, because I was going to say, I think the way I understand things now is we're so financialized that the S&P 500 crash itself is the actual recession. People in the old world thought about it as the real economy, but now, and I think you laid it out really well with the debt refi being impacted in a reflexive nature, that if the S&P goes down, the capital markets close, then the real world impacts. So let me just ask one more and then give it back to Nadine. We're coming up on the election. We talked about it a little bit. Do you think there's a component of your inflation reaccelerating call where everyone right now is doing the turtle move? There's uncertainty and the taxes. Sorry. But people are a little bit worried.
Physical, like he gave us a physical with the word. But I could view it as a trickle.
And they're being cautious, let's say. And so I was talking to Nadine about Neil Howe. I was on listening to a podcast, and he's like, well, will people accept it? Maybe like walk us through into the election, what a good scenario, what a bad scenario, and then maybe people start putting capital to work, and then that's where the inflation could come back. I mean, what's your thoughts on the next 5 months outside the data, just the process that as we walk through this?
Yeah, so I'll give you my thoughts and I'll back them up with data because I think that's probably make a better point. Our general thoughts.
We expect nothing less, Darius. We expect nothing less.
Good. I appreciate that, Nadine. Ben, in terms of our general thoughts on inflation, so I think we are approaching kind of the lows of the inflation time series for now. If you look at our grid model projections, if I can show those real quickly, we are kind of in the last 3 or 4 months of what we call bottom-up macro regime deflation, or at least we have that projected over the next 3 months, and then followed by Goldilocks. All of those imply that inflation is trending lower. If you look at our projections, we kind of have inflation bottoming in kind of early Q4 of this year. It'll start to meander higher throughout Q4, or at least according to our models. You won't really notice that as an investor. I don't think it'll have any real market impact until you get into the first half of next year, and increasingly so as the spread between our estimates continues to diverge from consensus estimates. That, in my opinion, represents a significant amount of market risk in the first half of next year in the context of what's priced into the money markets, in terms of the aggressive policy rate cuts that we have. But we'll talk about that later, obviously. But going back to the election, we do believe that, if you think about the 3 things that could cause inflation to reaccelerate, number one, we have, base effects are, largely going to contribute to that process. Number 2, we have what's more than likely to happen is that, if you go back, you study U.S. business cycles, we did a big deep dive empirical study on business cycles. And what typically happens is that what we find is that inflation is the most lagging indicator of the business cycle by a country mile. There's nothing even as lagging as inflation. And so what these charts indicate are the median delta adjusted Z-score for each of these time series before and after recession, with 0 being kind of the starting month. And so all of the 12 business cycles in the U.S. post-war U.S. economy are programmed into this study. And what we find is that on a median basis, inflation breaks down 12 to 15 months after a recession starts. It's by far the most lagging cycle within the economy. Policy is the most leading cycle, then corporate profits, then liquidity, then growth, then stocks, then employment, then credit, then inflation. And you can see it a little bit more cleanly in this chart here on the right, where we just show growth, headline CPI, and core CPI. And it's consistent with that takeaway. So, historically speaking, we would suggest that, okay, historically you've had, kind of a little bit of a drawdown in inflation heading towards it late in the business cycle, but then it's usually typically reaccelerates kind of very late in the business cycle. And I would expect to be 2025 to kind of, resemble that traditional pattern. And then lastly, with respect to the election, I think we can sort of have I don't want to step on too many toes here, but everyone knows that I'm very short. I'm short both Republicans and Democrats, and have been structurally short Republicans and Democrats for many years, because ultimately I don't think that we're having an appropriate conversation in this country about the direction of travel with respect to our national debt and what it could ultimately mean for our economic hegemony and whatnot. But that's a longer discussion. What I'm more concerned about from the near term and medium term inflation forecasting standpoint is that we're going to get populism no matter who wins the election. I say this all the time. If the Republicans, both parties are socializing the income of their constituents. Republicans socialize the income of the upper median of the income and wealth distribution in the United States of American, population, and Democrats socialize the incomes of the lower median income and wealth distribution of the population. You can see this through government social benefits divided by household income. It's literally been up and to the right for as long as my mom has been alive. You look at the effective corporate tax rate; it's been down and to the right as long as my mom has been alive. So this has been a multi-decade, multi-generational, kind of bipartisan assault on our fiscal balance as this function of politicians trying to get themselves elected. And so, and we understand that's kind of the nature of the political cycle here in the U.S. And the reason I would argue it's gotten accelerated in recent years, starting with Obama in 2008, and obviously Trump in 2016, Joe Biden in 2020. The populism, the size of the populism and the intensity of the populism has grown, in my opinion, as a function of this chart, where we show the corporate profits divided by GDP, kind of structurally elevated relative to the longer term trend, and where we show employee compensation divided by GDP structurally depressed relative to the longer term trend. This is the breaking of the social contract in America. And I would argue, kind of if you look at kind of where those lines really started to, kind of materially shift relative to their prior trends, it was kind of in the early 2000s. And I would argue China joining the WTO, NAFTA was probably a big contributor to that as well. We shipped all of our jobs to other countries, and of course we're going to wind up with populism. And maybe it was their master plan all along. If you ship all the jobs away and become the savior as a Democrat giving poor people money or as a Republican giving rich people money, that's how you get elected. And so perhaps it was their master plan all along. I don't want to go that far, but I do believe that no matter who wins the election, we're going to see more socialism, either socialism for the rich or socialism for the poor. And that's ultimately going to be wound up in more inflation. And so, the landing this plane on this discussion, if you go and look at what's priced into U.S. money markets from the perspective of policy rate cuts, the Fed, at least according to the most recent dot plot, which we all know is wrong now, is kind of projecting 25 basis points of cuts in 2024 and 100 basis points of cuts in 2025. Well, the markets are essentially saying we need almost 4 rate cuts in 2024 and 5 in 2025. That 5 in 2025, we would take offense to relative to our medium term views on inflation. And we could easily see a redo of, kind of what we saw in the first, part of this year, where we had inflation back up. We had a lot of rate cuts priced out of the, kind of near term rate outlook in terms of the U.S. dollar money markets. And ultimately that could cause some volatility in bond markets, perhaps from a, very asymmetric point. We could be at 350 on the 10-year, with those things, ahead of it. And that could cause some serious consternation in asset markets through the lens of liquidity. But again, I don't know if we're there yet in terms of putting that trade on.
And Darius, where does the inflation come from? Is it certain parts of this, of the economy, or is it all across the board? Where does inflation come from in that late cycle when you say it comes up?
Yeah, typically it's housing. I'm trying to find that chart here. So housing historically, if you look at shelter CPI, later in the business cycle, you have this massive deceleration in shelter CPI, only to have a massive acceleration very, very late in the business cycle in terms of shelter CPI. So that would be something that we're looking for next in 2025. And that would seem to suggest we're kind of getting towards that point. When you look at this on a time series basis, in terms of the most recent data, if you lag FIFA home prices and Case-Shiller home prices by 24 months to sort of account for the relative, the fluctuations in this business cycle, account for the lags that are, kind of endemic to this business cycle, we see that we're kind of in like the final 1 to 2 quarters of quote unquote more good news on the inflation front. Mm-hmm. And so we would expect to see a couple more good prints on shelter CPI and housing PCE. But as you move forward in time, we're going to be dealing with this, and we already have an observed acceleration in home price appreciation, kind of baked into the cake for 2025. So not a lot of folks are talking about that, but that will be one of those dynamics that we will be talking about if we're in the area code right on our projections.
And, I don't want to go too much through the frameworks because people can watch your videos and learn a little bit more. But, KISS is more of your retail framework, but on the professional side, you have 3 buckets, if you want to call them. One, you laid out your process to identify and position for the market regime. And that's your global macro risk matrix, KISS, Dr. Mo. You've got your prepare for the regime change using quant signals of the grid. So that's Goldilocks, reflation, inflation, deflation, your macro weather model, positioning model, global liquidity monitor. That's call it 3 to 12 months out, if you might. And then number 3, preparing for that regime change using qualitative signals. So the fundamental visibility out maybe 3 to 12, 3 to 10 years. So first, maybe walk through how you develop the frameworks, and then we'll get a little bit into some of maybe your more qualitative themes that you have going on.
Yeah, I tell you really quickly, it's very easy to develop how to develop frameworks. Books and battle scars. That's it.
Okay.
Books and battle scars and a little bit of Google. There's no. I tell this. I do a tremendous amount of mentoring with high school and college age kids, and they always ask me for a silver bullet. And unfortunately, there is no silver bullet. You have to do this at a high level for a long time to be good at it, and you have to be passionate about it because ultimately this is an industry that will chew you up and spit you out, and you will guaranteed to get burnout if you do not have the intellectual curiosity and the passion for it. That's how we develop these frameworks is just studying the frameworks of other really smart people. I've been flying around the world talking to institutional investors for the better part of 15 years now. Obviously, he's going out there to San Francisco to see you. I'll see you in Wisconsin at some point. It's and that's
It's probably one of the most important things you're telling people if they're not in the industry, because you probably get hit up a lot. I want to go in this industry, and you can tell right away if somebody has the passion and the wherewithal, because you have to be able to withstand that constant learning, the constant change, and learning about the markets and the participants in the markets. And really, if the passion isn't there, it's going to be really hard to stay in this kind of industry.
100%. Every day that goes by, I realize I know less. And I would say like that's like a curve, right? The early part of your career, you feel like you're learning everything, and you get to a point where you think you know everything.
No.
And then every day since then, I know less and less and less and less. And that's kind of what it is. And it's really humbling, and it's awesome. I mean, I think, all of my best, aha moments have come in, periods of, market turmoil or, P&L turmoil, and I'm not doing my job as good as I should be. And that's when you learn the most. And that's when you say, okay, this model isn't working. How do I fix it? This framework isn't working. How do I, who are the smart people that I trust?
Right.
To learn from their frameworks and incorporate them into mine. And it's a never ending learning journey that, I think if you're really passionate about it, you can really have a great, life and career doing this stuff. But I tell everyone, if you're in this for the money, you're not going to be good at it, and you will flame out.
Right. Yeah. That can't be the motivator. It has to be internal.
And so you said a good thing, right? Because complex adaptive systems like a market change, and then sometimes a time series isn't always, people get stuck in there. They're like, oh, this is what the price was, or this is what the multiple was, but there's just so many factors that go into that. And sometimes there's secular changes, like you could argue post-pandemic there's a different economy. So do you find a way that you say, okay, I'm going to be lighter on my conviction in these models if it's not corresponding to the data? And is there a point where you say, okay, it's falsified, it's not working anymore? Or how does that work for you?
Yeah, 100%. So we'll not only be lighter in our conviction in these models, we'll actually incorporate whatever it is that we need to learn into the models. So for example, one of the things that our models didn't do as well as I would have liked, going back to, let's call it the October of 2022, at the lows of the markets back then, they historically didn't switch up back to being bullish as quickly as they are good at getting investors out of the top. It usually took a while to get back, in at near to the lows. And so, kind of just learning from, other frameworks and, kind of studying other models over time, learn, okay, what are the kinds of indicators that you need to build into your model to make it do that better? Because that's a different, markets. If you think about stock markets, credit markets, risk assets, generally, they typically have these cresting tops and these sharp V bottoms. And so you build a model that's good at getting you out of a cresting top. It's not going to be asymmetric or symmetrically good at getting you back in a V bottom type format, because it's a different structure and different kind of different surface in terms of the price and volatility movement. And so that's the kind of thing where we'll say, okay, I know this isn't working as well as I'd like. How can I improve it? And we actually made those improvements. And I want to say our S&P VAM signal went from a 75% upside capture ratio to a 98% upside capture ratio.
Wow.
So yeah, I'm incredibly proud of that. That's a big difference, and it's obviously going to work well for our clients. If and when we have another market event, I think we already do a great job of getting them out near the top, but we're going to do an even better job of getting them back in near the bottom. In my opinion, that's really all that matters. I don't really care. I mean, I'll tell you right now, Nadine and Ben, I think I do as much primary research as probably anybody in the world in this industry as one human being. But at the end of the day, I actually don't care where the economy are headed. I don't care where the markets are headed. I actually don't care about the outcome. What I care about is waking up and executing our process every single day, because that gives us the best opportunity to respond to the complex adaptive system that is financial markets. We know that this thing's going to change. The stuff that we're looking at today will be very different than the stuff that we're looking at 10 years from now. The models that we're employing today could potentially be very different than the models that we're employing 10 years from now. But it's my job to do my job every day along the way so that we can make the appropriate changes and make the appropriate pivots along the way. I don't need to know where the markets are going to be on December 31st, 2024 or 2025. All I need to know is that if we're in a bullish market regime, a risk on market regime, or the risk assets that we're long are still in a bullish VAMS condition, then we can just remain long those things until they change. And that's really what I'm trying to do here.
And that's why you're the skipper.
That's why you're the skipper, right, buddy?
Yeah, that's why you're the skipper. But
Exactly.
Can we get to some? Sorry, I tell somebody I can't get him in here. We're I don't know why someone's trying to get in. So we talked about sticky inflation, but can we go to the resilient U.S. economy? So, you've got solid private sector balance sheets, limited exposure to rates, cyclical manufacturing, labor hoarding. We can kind of go on and on. Maybe walk through why the U.S. economy is being resilient. And then we can go to a few other ones, but would love to hit on some of your more qualitative themes.
Yeah, absolutely. So as like I said, the qualitative themes help us give our clients the conviction and emotional, to release the emotional baggage that they might have with the previous theme or the previous market regime when we transition to the new regime. I'm telling them, hey, this is the stuff that's going to happen in the economy. So when you finally get the signal that says this is the new regime, do X, Y, Z in your portfolio, you feel confident to make those changes as opposed to having to waste time or having some latency associated with not understanding where we're supposed to be or where we're headed. Because I think, it'd be one thing to have a trend following only process, which is what a CTA or quant would do. But in our opinion, what we're trying to do is be quantamental, because that ultimately, I think that gives us the opportunity to have the most, positive outcomes over a long period of time. I think if you had error in a trend following only process, you're not, you're going to be more quick to, stop following the trend following only process, in my opinion. And I think ultimately that's what you don't want to do, because obviously no process is 100% back test. So let me get back to your question, Nadine. So on the resilient U.S. economy, I'll sort of fly through the 5 pillars of the resilient U.S. economy theme, and then walk through where we are today and why we are pretty convicted that have been and continue to be convicted that there's no recession. Recall that at the beginning of August, most people thought there was a recession on the horizon. We were very much in the camp that did not. We were very consistent about that, and obviously, I think that's kind of played out in some of the data that we've seen since then and market movements that we've seen since then. So on the resilient U.S. economy theme, I'll start here. This is real final sales to private domestic purchasers. 5 of the last 6 quarters, we've been at or above trend on a quarter-over-quarter SAR basis in real final sales. I mean, that's just, that's a positive, and that's as strong as the U.S. economy can and ever will get. So, and obviously we did a good job of calling for that, in the summer of 2022, when we're kind of at the lows of that cycle. In terms of the 5 pillars of upholding the resilience economy theme, there's a historically strong household sector balance sheet. The thing I highlight on this slide is the overwhelming amount of cash that we continue to have on the household sector balance sheet. If you combine household checkable deposits and currency plus their money market fund exposure, we're up at $8.5 trillion. I want to say data through Q1 of this year. That is up from, kind of $3.5 trillion prior to 2019. So more than double the amount of cash on household balance sheets. It's 5% of total assets. You got to go back to the early 1950s to see such a high share of liquidity on household sector balance sheets. So that's one thing I'd highlight there. The West Village Montauk effect, we talked about that briefly earlier, which essentially says, okay, this large stock of cash is causing a negative flow of savings when you look at the personal savings rate. And so a lot of investors are sort of been, in my opinion, mistakenly sort of thinking about this from the perspective of consumers being tapped out and not having savings and having to draw down savings. But the reality is the stock of savings that they built up in the immediate months and quarters following the pandemic, the onset of the pandemic, through, obviously the fiscal monetary largesse that we experience as humans, that is still very much there. And the Integrand is going to take perhaps several years to kind of flow out of the system. All right. And so the second part of the West Village Montauk effect is understanding that the U.S. is a K-shaped economy. And the upper part of the K, this part, is a lot longer than the short part of the K. And what I mean by that is when you sort of, break apart the consumers into different, income cohorts, and specifically isolating, let's say, the lower third, they only account for 15% of consumer spending in America, whereas the upper third of, consumers by income cohort account for 51% of consumer spending in America. So, this concept that the, sort of lower income, below median sort of income and wealth of the distribution, those folks are tapped out, and that may be true, but the reality is the folks that, kind of really power the U.S. economy are not tapped out. If anything, they're going to be going for quite a while in the context of this analysis. And then we talked about briefly the historically strong corporate sector balance sheet, going back to the liquidity dynamics, we're $3 trillion of cash on corporate balance sheets in terms of checkable deposits and currencies. That's, up from about $1.5 trillion at the end of 2019. So double there. And if you look at it on the share of total corporate assets, it's 5% of corporate assets. You got to go back to the 1950s to see such a high share of liquidity on the corporate balance sheet. So that's really positive at the margins. We have limited exposure to policy rate, which we talked about. And then finally, we have limited exposure to the more cyclical manufacturing sector. So if you look at manufacturing as a share of non-farm payrolls of GDP, it's at 14 and 10% respectively. Those are essentially all-time lows in terms of their respective shares of employment in the economy. You go back and you look at The manufacturing was a much higher share of non-farm payrolls, a much higher share of GDP. The red bars in this chart are a lot more clustered together. There's a lot less space in between the red bars because the more cyclical part of the economy was a much larger share of the economy. Specifically, the manufacturing sector has accounted for a median 98% of net job losses in post-war U.S. recessions. So, the services sector almost rarely has a contraction in output and employment. It's the manufacturing sector that tends to cause recessions, and understanding that the U.S. economy, we shipped all of our jobs to China, Mexico, et cetera. We no longer make anything here. So it's very unlikely that we have a very cyclical economy going forward. We have an economy of folks getting their hair cut, their nails done. And those things keep happening and they don't stop happening. They get the dry cleaning, Exactly. I need haircuts. So it is what it is. So yeah, that's the resilience economy theme. And then lastly, I'll kind of land the plane on, is the U.S. economy heading into recession with respect to our business cycle analysis? And our key takeaway is probably not, more than likely not over medium-term time horizon. And so, as I mentioned, we did a empirical study, trying to identify what are the leading, lagging, coincident variables in the economy across hundreds of time series, and kind of isolating the key ones that we all care about as investors. And what we found is that again, there's a real process to how the business cycle works. It doesn't just willy-nilly, we're in a recession, we're not in a recession. That's not how it works. There's a real sort of sequence to the events. As I mentioned, policy tends to tighten. If you look at when policy tightens, kind of breaks down, everything's delta adjusted. So the chart makes sense. It's easier on the eyes, but policy tightens, kind of 12, 15, 18 months out of a recession. Then you have corporate profits breaking down, let's call it a year ahead of recession. Then you have liquidity breaking down shortly after that. Then you have growth in the markets breaking down, let's call it 6 to 9 months out of a recession. Then you have employment kind of breaking down right when the recession starts. Then you have credit breaking down, let's call it 1 to 2 quarters after recession starts. And then finally, inflation breaks down, let's call it 4 to 5 quarters after recession starts. So if you wanted to forecast a recession based on how the business cycle has historically behaved, we understand that may not be true going forward, but we don't know, we don't have anything else to look at, so we might as well look at the things we have to look at. So if you wanted to forecast a recession, you want the chart on the right, which is the current data, to look like the all the other business cycles, or at least the median of all the other business cycles historically. And right now we have policy being very tight, but we don't necessarily have the other things you would expect to see over a medium-term time horizon. We don't have corporate profits breaking down. We don't have liquidity breaking down. We don't have growth breaking down. We don't have stocks breaking down. We don't have any of that stuff breaking down in terms of anticipating recession. So we still have a lot of confidence that there's unlikely to be a recession over a medium-term time horizon. I don't think we're as non-consensus with that view as we were a month ago and 2 years ago. I think that view has somewhat become consensus.
But do you care if things are slowing? Is it really like recession matters and non-recession doesn't matter? Or is it just the fact of slowing causes potentially risk assets to have issues?
No, that's a great point. I mean, the slowing could cause risk assets to have issues, but in the context of our views on growth, we're expecting growth to remain above consensus throughout our medium-term and forecast horizon. Okay. And if that's the case, if we're right and growth is consistently and generally surprising to the upside, you could actually have a positive tailwind to asset markets as a function of that. Got it. So, if you think about growth and inflation, there's sort of 3 things you need to know as an investor. I think the most important thing you need to know is where's it headed, the direction of travel. The second thing you need to understand is, okay, it's the direction of travel relative to what consensus expects. Right. And then I would say the third thing you need to understand is kind of the level. Are you going to a below trend or above trend level? We still have growth. We don't have growth slowing to a below trend level until you get into the first quarter of next year. And so that's quite a ways away. I don't expect there to be any market risk associated with a moderation off the very, very high level of growth over the medium term and surprising to the upside. So in our opinion, we think that could catalyze some positive dynamics in asset markets. I'm much more concerned about asset markets when we get into the first half of next year, where our grid regime projections really start to materially diverge from consensus.
And your third one is like Jay wants a soft landing. So given that we're headed into probably a rate cut coming up here, maybe walk through why has he wanted a soft landing, and looking ahead, what are you expecting as his wishes, desires, and hopes for rates, right, in the economy?
Yeah, well, I think it stems back from, in our opinion, so you, Nadine, Neil Howe, who's one of my former colleagues and one of my mentors, is the author, or the co-author of the Fourth Turning Framework. I don't think we have time to kind of unpack all that in this discussion. But the general takeaway, one of the things that we've learned doing a big deep dive study on Fourth Turning, economic and market and policy dynamics, is that the Fed has a significant role to play. And the reason the Fed has a significant role to play is, historically speaking, we've had significant, blowouts in the federal budget deficit in these fourth turning periods. I mean, the biggest budget deficits we've ever had in the U.S. economy have all come in these fourth turning periods, and we're currently in one. And according to Neil, we're likely to remain in one until late 2020s, early 2030s. And so we've only seen a moderate preview of kind of the blowing out of the budget deficit that we're likely to see. We suspect the dual tailwind of Republican socialism and Democrat socialism will create more of a tailwind for budget deficits. But ultimately, there's a crisis coming that we don't know, it's unforeseen, that is going to cause a real significant deterioration in the budget deficit. And so how the Fed has historically, in terms of how the Fed has historically dealt with that, is that they've tended to have real, 12-month nominal, real. If you look at the real T-bill yield and the nominal T-bill yield, they're typically much lower in these fourth turning regimes than they are in other regimes. And so what that tells you is that the Fed has historically been ultra accommodative in these fourth turning regimes to allow for this explosive growth in the federal budget deficit. And so in our opinion, we think the kind of part and parcel with our Jay wants a soft landing theme is the underlying expectation that the Fed is going to be more easy than it probably should in the context of its kind of growth and inflation mandates. Maximum employment and price stability would suggest that interest rates are probably don't have much room to go down, probably up 100 basis points at most, and probably don't need to start soon based on where we are in the growth cycle and employment cycle. However, they're going to start cutting rates in a couple of weeks. They're probably going to cut rates a couple more times between now and the year end. And don't forget, inflation is still above trend, comfortably above trend. And so they're cutting interest rates with inflation comfortably above trend. In my opinion, I think that tells you everything you need to know about the Fed's asymmetrically dovish reaction function. But if you need to hear more from that, I'm happy to explain.
Well, I think the bigger risk is, let's just say your resilient economy's right, and they keep spending, like the spending keeps coming. Although as the rates come down, that will help the deficit a little bit. I think it's every 100 basis points, about $100 billion off the deficit. But okay, so we'd say we have a little bit of a downturn here. They start cutting, dollar weakens. Foreigners' allocation to the U.S. is enormous. Household allocation to stocks is enormous. Yeah. So people kind of, all those case or whatever, the rich people who spend the money, they start to feel that in their balance sheets. And everyone kind of freaks out. And then the government comes in and they, do what they do. Like, right, they stimulate. But your underlying view that the economy is actually okay. So you could have a collapse of the prices of assets to the economy, and the economy doesn't have to tank. Do you know what I mean? Like that seems like a scenario that I think is realistic. And then what if they do that? And then the right tail risk is that's where the bonds, to bring it back to your point about inflation. Like, I mean, that's not a lot of guys talking about that. I think everyone's just doing the normal regime cycle, but maybe on the other side, right? Like, isn't that the bear steepener type of risk, the real risk for everybody?
Yeah, in our opinion, I think they're both risks. We saw what the bear steepener risk was in 2022. I think it would just look like a milder form of that, relative to the starting point. The starting point back then, right, was all-time lows in interest rates and all-time highs in bond prices. So clearly, we're going to have a much bigger drawdown, from the highs of 2021 in that scenario. I don't think we have the kind of acceleration of inflation risk on the horizon, nor do I think we have the kind of duration risk, and we don't have the kind of duration risk in the bond market, so you won't see the kind of declines. However, we could see a mini version of that next year. I think you brought up as another point in terms of because I think there's tail risk, there's dual, there's two-sided tail risk, and they're both negative in my opinion. So we kind of have to land the plane in the sweet spot of a soft landing in order to continue perpetuating, rising equity multiples and tightening credit spreads. And I think you brought up something that I think is, I don't want to say misunderstood. I just don't think it's talked about. Like you as much as anybody I know, Ben, understand these capital, cross-border capital flow dynamics as well as anybody. And for the life of me, I can't get anybody to tell me what the net international investment position of the U.S. economy is. Right now, we're at, at least data through December 2023, we're at minus $20 trillion in terms of our net international investment position, which is all the claims that foreign creditors have on U.S. assets. That number has doubled over the past 5 years, from minus 10 to minus 20. We have doubled the amount of claims that foreign creditors have on U.S. assets in the last 5 years. Doubled to $20 trillion. And so when you think about this in the context of the yen carry trade unwinding, which you and I have talked about in our program, in our opinion, this is the risk. It's not that the U.S. economy slows into a recession and we all heck breaks loose. I think that would exacerbate the unwind of these dynamics. But just the fact that we have a normalization and compression of the spread between Fed and Japanese government interest rates, or the Bank of Japan policy rate, in my opinion, if we continue to see an acceleration of that compression, it's likely to contribute to an unwind of this positive inflow into the U.S. economy. It's going to result in net capital outflows. We saw exactly what that looked like in the first week of August. We could have months and months of that type of dynamic without the U.S. economy, heading into a recession, just as a function of accelerated BOJ policy normalization and a accelerated Fed policy normalization. And in that context, I think I don't have a chart in this particular slide deck. I don't think I have a chart in that slide deck, but in that context, one thing I'd call out is, no one's talking about this either, Japanese wage growth on a nominal basis just accelerated to the highest level we've seen since 1997 after the rate hike. And so investors should be expecting the more and more Japanese policy normalization. And when you look at what's priced into JPY money markets, it's not much. It's like the markets aren't really betting on that outcome. And to me, that represents a tremendous amount of market risk relative to what we have. If you look at what 1 year overnight index swaps are pricing in for the Japanese government for JPY money markets, it's only 21 basis points, basically one more rate hike. That could be 2 or 3 more rate hikes.
So staying on that, Darius. So basically you're saying rates going up in Japan, maybe elsewhere, and our rates going down. Therefore, money flows to where they, maybe back home and to Japan, right? Yeah, they go back to Japan or wherever, or at least don't want it here because they're not getting what they got before. And so how does someone prepare or play for that? You're obviously going to alert them to when this issue is coming and what to do, but maybe give a preview of how does someone deal with that in their portfolio? What should they be doing?
Yeah, 100%. So in simplistic terms, that just means you're pricing in deflation in the context of our market regime nowcasting process. And so deflation, just simply, you generally want to favor defensive assets over risk assets. And from a beta perspective, you want to be low beta over high beta. You want to be in defensives over cyclicals, growth over value, large caps over small caps, so on and so forth. In the credit markets, you want to be long, treasuries over spread products. If you're in credit, you want to be high grade instead of high or investment grade instead of high yield. Dollar tends to work well in these types of environments, but very unlikely to work well in this type of scenario. And so, generally speaking, well, ultimately what that means is if we fall into tail risk, A, which is unwind of the yen carry trade, it's going to be deflation. What I suspect might happen in 2025 is tail risk scenario B, which is more inflation, and inflation starting to diverge relative to consensus and Fed expectations, causing a repricing of the bond market. That's what we call inflation. And then you're going to want to be, you still want to be defensively positioned, but you're going to want to be low or sort of short duration as a defensively positioned investor. So that's a big difference in terms of the pivot you would have to make. And ultimately, I think the deflation is more likely over the near term. Inflation is more likely over the medium term. But ultimately, we, between now and year end, we still think there's a reasonable chance of markets, squeezing themselves into Goldilocks between now and December 31st.
Yeah, so it is. I totally with you. I think it's positioning, global position. I mean, Lacey Hunt's been talking about this net negative savings for a while, and if that money goes home, I've showed this chart before, but if you look at the late 60s, you look at 99, you look at 1929, you look at now, strong dollar regimes, right? So there's money here that's boosting the assets, and I think 40% or 45% of the U.S. market is foreign owned. So if we have the highest percentage of household allocation to equities domestically, and then we have the highest percentage of foreign, so this can just unravel without anything to do with the economy, and then the confidence ensues, right? And then so this is what I was interested with you, and now I know, is the positioning of the markets can lead the data in essence, right?
Oh yeah, I think the more I've done this, the more I realize the positioning does lead the data. And that's why our process is oriented the way it does. Our process is, the step one of the process is identifying position for the market regime. It's not forecast growth and then position for where you think growth is going to be, or forecast policy and position for where you think policy is going to be. It's identifying position for the market regime, because the markets will beat you to your forecasts. They almost always beat you to your forecasts. Yeah. We use forecasts to help clients anticipate changes in the market regime. So again, that they have the emotional confidence to make the changes when it's time to make the changes. If you don't know where growth and inflation and policy and profits and liquidity are headed, then if you have a change in the market regime, it's going to be like, oh my God, what the heck? It's like if it just. Have you ever seen a snow squall? By the way, I saw that for the first time last year. They come out of nowhere and it's freaky. That's what a market base transition looks like. It feels like if you don't know where you're headed economically. And so what we're trying to do is make clients feel like it's we're forecasting the weather as far as we can possibly do that, as opposed to having a snow squall that they wake up to on any given day. So I think it's a better process.
And I know we're coming on the end here, but can I come to China, because I know you do a lot of work, and one of your themes is also China front-loading stimulus. And I've been writing about China for a long time now, and your point is they need to counter structural debt deflation. They want a weaker dollar to enhance the PBOC's ability to implement aggressive monetary policies because it reduces the risk of currency instability and capital outflows. But maybe kind of walk people through it, whether it's data or just your thesis on this. And what do people do about that? Because they obviously have been a huge growth driver in different periods for the global economy. A lot's changing geopolitically, a lot's changing in terms of where pockets of growth and strength and otherwise are. And our elections are coming up. So there's so many things going on that I think people have been caught, right, hoping that China would do more. They're not getting the benefit of the asset markets for it. So from here on out, what do they do?
Yeah, great synopsis of the thing, Nadine. So I'll start by saying, we've been of the camp since early 2023 that China was going to reopen its economy into essentially a structural liquidity trap.
Yeah.
And what we mean by a structural liquidity trap is that the incremental unit of credit is going to service previous credit as opposed to financing new growth. And that's generally speaking what we've observed in the Chinese economy since then. The reason we had that conclusion is that, if you look at, some of the key metrics that would give you, an indication that that's where their economy is likely headed, China is already kind of bright red in terms of flashing red in those metrics. So if you look at their private non-financial sector debt GDP ratio, it's 200%, and it's probably low relative to all the actual numbers. We all know that China, kind of has this, very convoluted financial sector that probably has a lot more leverage and hidden leverage than we can observe. And so that it's already, with the leverage that we can actually observe, it's already as high as Japan's was, kind of in the late 80s, early 90s, when they were heading into their structural liquidity trap. And if you look at investment as a percentage of GDP as a proxy for capital misallocation, we're at 42% now. We were just shy of 50% at the peak in the early 2010s. And those numbers are well north of where Japan was, when it had its capital misallocation boom in the late 80s. And so you think about, okay, where's the Chinese economy headed from here? It's probably something that looks a lot like Japan. And so in our view, the reason that we have this China front-loading stimulus theme is that we don't think Beijing is going to sit on its hands and just kind of let that outcome occur. They're a neighbor, across the water. In Japan, they recognize that process took 20 years. I don't think the Chinese Communist Party has 20 years to go through a process like that. So in our opinion, we ultimately think that they're going to stimulate the economy vis-a-vis fiscal and monetary stimulus. They've been sleuth-footed on that, to say the least. We've been underwhelmed at how little they've done. We've been underwhelmed at how much they've done, or they've been really disappointing in terms of how little they've done. And part of the reason for that is that we've had this strong dollar regime for quite a while. Right. And ultimately, we're starting to see that strong dollar regime come to fruition. And the reason that matters, in our opinion, is because if you go back and you kind of look at the monetary dynamics in China, to me, I think it's really just a function of the dollarization of the Chinese economy. People realize, like, China is by far the world's largest dollar-denominated borrower outside of the U.S. Yes. By far, by a country mile. And I don't think most investors realize that, because China has a closed capital account. But obviously, they found a way to get around that in terms of foreign bank lending and international debt security issuance. And so this chart here shows the PBOC's balance sheet. It's around 44 trillion yuan right now. The black line, the red line shows the FX reserves in China, and FX reserves in China really started to materially diverge from the growth of the PBOC's balance sheet, really starting in 2014, right at the kind of the last time the yuan got really, really strong. And this is right ahead of the 2015 devaluation. And so since that process has occurred, you started to see the growth of the PBOC's balance sheet in excess of the growth of in foreign exchange reserves. And the reason for that is that you've had Chinese corporates, perpetuating capital outflows vis-a-vis retained earnings. They're leaving the money that they make abroad, because they understand that there's probably a currency devaluation coming. And they've been doing that basically for 10 years now. And so ultimately, what it ultimately means is that if the PBOC wants to step on the gas, they have to allow the yuan to, basically go into free fall, if in the absence of these repatriating flows. And so that's kind of the key takeaway from our, one of our, in the context of the Japanese yen carry trade unwinding and the broader, risks for asset markets. If you had a weak dollar policy here in the U.S. and that got perpetuated, and that's exactly what money markets are pricing in, by far the most rate cuts over the next 12 months relative to peer central banks. And so if those rate cuts come to fruition, you're going to have a persistent downtrend in the dollar. That would allow the PBOC to step on the gas further, without having to risk a destabilizing decline in the Chinese yuan, which would ultimately get this party, jumping to, right now it's popping. Right now it's popping. The capital outflow party in China, it would be jumping. Those are technical terms.
Yeah, right. Super technical, data-driven terms. Yes,
exactly. So landing the plane on this, the final thing I'll say is that, you could have a scenario where we have yen carry trade unwind, money repatriating back to Japan from the U.S. Over the medium term as a function of the weak dollar policy. What would offset that is if China, Beijing, steps on the gas to provide ample fiscal monetary support to stave off the structural debt deflation that they're likely headed into. If they don't do that, then it's just, we're going to see a lot more of what we saw in early August. If they do that, then you could have these sort of two countervailing forces, one bullish, one bearish, and ultimately you could have a, somewhat, sanguine resolution in asset markets. And so that's kind of our general expectation, is that we're going to have that that kind of those countervailing forces and that sanguine resolution to asset markets over the next few months. But between now and let's call it September 30th or mid-October, this is the worst time of year to be long any risk assets. So I wouldn't put a lot of confidence in that view until we see a little bit more volatility in my opinion.
Got it.
And just one last thing with that, is there something you'd like to tell our listeners to that of like, hey, this is the worst time of the year. We have an election. There's a lot of uncertainty, but listen to your data, take a look out, and be ready to do what you want to do with the look out. And because it's going to be choppy, no matter what, it's going to be choppy. I mean, and it doesn't sound like you're super negative on the U.S. economy, but we have all these things that the market could go. We could go to 4,800, no problem, right? And nothing really changes in my mind.
That seems really low.
That's how high we are. It's crazy.
Yeah, no. I mean, I guess we saw a preview of that in early August. Yeah, I don't disagree. I think we probably need to have recession fears reinstated. To have such a precipitous decline to such a low level relative to where we are today. I do think we probably, don't forget, this September is usually, I think, the first or second biggest month of corporate debt issuance. We got an election on the horizon. Folks got to hedge for that. I don't think they have to hedge for that, but they will hedge for that. And so those are the kinds of flows that could create negative outcomes in asset markets in this seasonally weak period. But in my opinion, I think that's more, trees and not forests. The forest, it goes back to where we started the conversation with, is if you don't have a sharp and unexpected and protracted decline in growth, or sharp, unexpected and protracted acceleration in inflation, or sharp, protracted and unexpected tightening of monetary and or fiscal policy, usually both, you're probably not going to have a sustained risk-off market regime. You need to have one of those three things occurring. And right now, between now and let's call it December 31st, it's unlikely that any of those things occur. So the path to least resistance is probably higher between now and year end, maybe into the early part of next year. But in 2025, we do see market risk developing associated with a, protracted and unexpected acceleration in inflation, associated with the kinds of terms of the duration risk we could see in the bond market that could ultimately spill over into what could be at that time, if we're anywhere near 5,800 or 6,000 S&P, that's a tremendous amount of duration risk. You're going to have to price into the equity market as well in the context of some of these very aggressive multiples in the tech space. So, that's me trying to, paint the bouncing ball all the way forward. But the reality is all that stuff could be wrong. And at the end of the day, that's not how we tell clients to position for. We tell clients to respect the evolution of the market regime and position for the market regime. And if we're right, then the market regime is going to turn into Goldilocks and then turn into inflation after that. And if we're wrong, then we'll just be wrong on those fundamental views while making money along the way.
Yeah, and I just want to make one last point to that. Even if we go to 4,700 by Halloween, that still means we're up like double digits year over year versus the Halloween before. So let's just remember and put this in perspective, okay?
That's true. We've had a good run, man. We've been bullish. It took us a while, going back to what we talked about earlier, the VAM signal improvement. We didn't turn bullish until January of 2023. So it took us 3 full months from the lows of October 2022 to turn bullish. And that was, in my opinion, that was a really tough period of performance for me personally. I learned a lot in that period, both in terms of, okay, we need to pivot our process to be a little bit more systematic, but also in the context of, okay, what are the things that other investors are doing to, get them in sooner, faster, better after they call the top. And so that's the kind of, I'm really fortunate for that period of poor performance because I did learn a lot in it. And ultimately, our clients are benefiting from that here at 42 Macro.
Well, I think that's a great place to end. So I know we could spend hours with you, Darius, because we have spent hours with you getting in
Yep.
the macro weeds. But I want to first thank you for sharing all of your wisdom and experience with us and everyone today. But I also want, so that people can get your data. How do they find you? Where can they look for, working with you if they're interested? What's the best place?
Yeah, I appreciate that, Nadine. So I'm pretty approachable. I mean, obviously we have our website, 42macro.com. That's probably the easiest place to gain access to our research and our client dashboard. We have this awesome dashboard where the clients can, see our signals, see our research, and obviously interact with us, me, and each other. And I think it's an awesome, safe space for learning that, I'm really proud of that we built. So that's 42macro.com. I'm obviously available on Twitter. Darius Dale at 42. Darius Dale 42 is my Twitter handle. LinkedIn, I'm available on LinkedIn as well. So, reach out if we think we can add some value to your investment process, and if not, we'll just catch back here on the next one of these chats. Okay, I want to say you guys are doing a great job. I find that there is a dearth of institutional grade conversations on finance podcasts. There's a lot of really awesome stuff. There's a lot of smart people talking about charts and things of that nature, so I enjoy them generally speaking. But there's a lot of bear porn and doom porn and a lot of stuff out there. And I think what we're trying
misnames, didn't someone like misname that you said one regime and they had the title of, I won't say who it is because he's local, a totally wrong regime. It's like, were you even listening? Yeah.
Totally. So what I think you guys are doing and which I'm really appreciative of, and I think your audience should be very appreciative of, is there's two ways to grow an audience. One is the fast way, which is clicks. How do I trigger you emotionally to get clicks? The other way is the slow way, which we're doing at 42 Macro, and I think you guys are doing with your podcast, which is I want to add value. And I want to be right, and I want to add value, and I want to be right, and I add value. And I think it's a slower way to grow, but it's a more sustainable way to grow. So I really want to tip my hat to what you guys are doing and building because it's awesome.
Awesome. Respect to you as well. Thank you, Darius.
Appreciate you.